Okay, let's take a look at some practice exercises that'll help you with your homework. So this first one, exercise 10-2B, deals with an installment note. So a company has borrowed, in this case, $80,000 from First Bank. They've issued a 4-year 6% note. So the bank has determined that their annual payments are going to be $23,087, and they make them at the end of each year. So here we've got a grid, and again, we need to do this amortization table in order to know how to record each payment that we make at year end. How much to, of course, we're going to reduce cash by $23,087 in each case, but how much do we decrease the balance of our note payable, and how much do we recognize as interest expense? So in the first year, the amount that we owe during the entire year is $80,000. We make a $23,087 payment. So the amount I want to apply of this amount here, the amount I want to apply to interest is going to be the amount that I've owed all year times the rate of 6%. So I'll record that as $4,800. That means of this $23,087 payment, $4,800 is interest, so the remainder must be a reduction of the principal, or of the amount that I owe, $18,287. So that gives me an ending principal balance on the note of $61,713. So that becomes the amount that is due the entire second year. Make the same exact payment. Now in the second year, my interest is going to be $61,713 times 6%, or $37.03, rounding to the nearest dollar, by the way. So the remainder is $19,384, goes to principal, which reduces the amount that I owe to $42,329, which is the amount I owe the whole next year. Make the same payment, calculate the interest, and so forth. You see the pattern here. Now when it comes to the last year, because we haven't been doing this to the penny or fractions of a penny, it will end up with a balance of $2, which we can't have. So in that last year, I see that my remaining principal is $21,782. I know that that portion of my last payment has to go towards principal, so I can back into what the interest would be. I think if I did $21,782 times 6%, I'd get $13,07. So I need to record interest $2 less just because of that rounding error. But the key thing is this ends up at 0. So that's the first problem in your homework. The second one deals with bonds payable and how we treat the transaction. So in this case, the bond is issued at face value, which means we issued a $300,000 20-year 6% bond, and people felt that that was a reasonable interest rate, and so they gave us $300,000 for that. So in that case here, the first transaction, we get cash of $300,000, and we have bonds payable, a long-term liability of $300,000. It says we turn around and use that cash immediately to buy land. So cash goes down by $300,000, land goes up by $300,000. Then it says that we lease the land for $50,000 in cash revenue. So we get $50,000 of cash and we recognize $50,000 of lease revenue. And then we pay the interest. And again, the interest on this bond payable is going to be $300,000 times the 6% contract rate. So it's $18,000. So we cut checks for $18,000 to all of our bondholders, that much in total, and we recognize $18,000 of interest expense. Then I have my year-end totals here, and I can see obviously that both sides are $332,000, so I'm in balance. And then the second year, again, I get the $50,000 in lease revenue, and I pay out the $18,000 in interest expense, and I'll keep doing that year after year after year. So pretty straightforward. And I'm going to skip the financial statement part of this, and I want to show you the last one, which is 10-10B. So this deals with that nomenclature of how bonds are issued. So when they're issued at face value, we say they're issued at 100. So if they're issued at something above 100, that's called being issued at a premium. If it's below 100, that's issued at a discount. And this number here, 101, 98, 102 and a quarter, 97 and a half, those are actually, think of them as percentages, okay? So in the case A, $400,000 8-year 8% bond at 101, 400,000 times 101 is, think of it as 400,000 times 1.01. That would give us cash proceeds of $404,000, which is a $4,000 premium. The next one, $250,000 at 9.8, so that is at a discount, meaning I'm going to get less money than what I owe. So multiply 250 times 0.98, I get 245. That's a $5,000 discount. Next one, 300,000 at 102 and a quarter. That's at a premium again, so I multiply by 1.0225. I get 306,750 for a 6750 premium. And then the last one here, a $200,000 note at 97 and a half. I'll multiply by 0.975 and get 195. That's a $5,000 discount. So hopefully you found that helpful. If you have any questions, please shoot me an email. Thank you.